Hello, everybody. Welcome back from lunch. I know during the early part of the day, there was a lot of, most of the panels were revolving around AI, data science, things of that nature. There was a little bit of blockchain thrown in there. This panel is really going to focus on the digital assets that move on top of those blockchain rails. And so we've got a really great cast here. But let me just set the tone here. So my name is Tony Tuths. I'm a partner at KPMG, and I run the digital assets practice there. And that's really ranging everything from the new development companies that are creating the new L1s, L2s, and the infrastructure that makes the whole blockchain ecosystem run, as well as obviously the large venture funds that invest into the space, all the way out to our Fortune 250 companies who are starting to use digital assets in their own business model. So really runs the whole gamut. And so what we have seen over the past year, and that's why the theme of this panel is 1 year on, because since this event last year, a lot has changed. Sure, technology came along a bit, it always does, but probably more importantly, at least in this country, was the change in administration, the change in the regulatory environment, what we're allowed to do here and where we see things going. And obviously that has a huge impact on what products are available in our markets and what the price of those products are. So we're going to talk about, we're going to talk about digital assets, obviously, but when I use that term, I'm speaking of everything from, Bitcoin, ETH, Solana, crypto as you know it, but also tokenized real-world assets, the new digital asset treasury companies that we see trading, and then derivatives, things we see trading on centralized exchanges and decentralized exchanges. So it's really going to cover the entire gamut. And we've got some experts here to bring us some insight. So let's go down the row, some quick introductions, and we'll get going.
Hello, everyone. My name is Rob Strebel. I'm Global Head of Relationship Management at DRW in Cumberland. Today, I've got my Cumberland hat on. We are a liquidity provider in the digital asset space. We've been around since 2014. From a liquidity standpoint, it's spot and options within digital asset space, but we're also builders from VC to incubation. We're also involved in building and pulling TradFi into the digital asset space through things such as digital assets and digital assets holdings and Canton, which you all may have seen in the press earlier today as well.
Okay, thanks, Tony. Thanks, Vivek. Thanks to the entire Barrel team for putting on, again, another great day of programming, which will extend tonight and into tomorrow as well. So excited to be here. My name is Adam VandenBoogaard. I am the head of revenue for Copper in the Americas. Copper, for those who may not be familiar, is a digital asset infrastructure provider. Provide institutional grade custody for institutions. We are the kind of pioneer and continue to operate the leading off-exchange settlement solution known as Clearloop. We also offer collateral management services, connectivity to exchanges, DeFi, an OTC trading desk, agency lending, and some pretty robust settlement rails. We have to say that we're building the institutional standard for digital assets.
Great, and thanks, Tony, and thank you, Vivek, wherever you are, for having me here. Really appreciate it. My name is Sam Gaer. I'm the CIO at Monarq Asset Management. At Monarq, we run 3 different funds, a market-neutral dollar fund, a market-neutral Bitcoin, as well as Directional Systematic, which is the fund that I run. Previously, I've been at Block Tower and held some pretty notable positions in the industry, such as CIO at FINRA, CIO at NYMEX, CEO of NYMEX Europe, and COO at NYMEX. It's wonderful to be here. Looking forward to the conversation.
Hi, everyone. I'm John Dagostino. Sam left out his most notable position, which was my first boss, right? I mean, so...
Never heard of you.
My name is John Dagostino. I'm head of strategy at Coinbase Institutional. We are a crypto exchange. We like to think of ourselves as the largest regulated crypto exchange in the world. We operate a prime broker. We have a custodial and self-hosted wallet. We do a bunch of other stuff, but that's the meat and bones of it. And very excited to be here. Thanks for having us.
Excellent, thanks. So as you can see, we've got some of the best in the industry here to talk about digital assets. Let's just dive right into it. We're here to talk about what have we done over the last 12 months since we had this conference last. Where's the market today? And so, John, let me turn that to you. First of all, from Coinbase, I mean, you can see the markets pretty clearly what's been going on, and you're also involved from a policy perspective, I know, as well. So what's the biggest wins you've seen this year, and what's been happening?
Sure. And then just to be clear, I speak for myself, not for Coinbase, right? I like my job. So I think the way I phrased the question when I gave it to you was what's the most interesting thing that's happened, and also maybe what's the most overplayed or overhyped thing. So I'll answer both quickly. So to me, I think the most interesting thing that's been ignored, the most underplayed high event, has been this unlock that we're seeing now from the big RIA platforms, the Morgan Stanleys, the Citis, JP Morgans, where management sort of is capitulating and saying, okay, we are going to allow our army of registered brokers, high net worth advisors, RIAs, whatever you want to call them, to start proactively recommending and selling digital asset products, right? I think that you heard the story. The story came out, Morgan Stanley noted, and then they followed it up with, we were going to recommend a 2 to 4% portfolio allocation for a typical high net worth investor. That's just massive. I believe that these products will continue to be sold versus bought, but they're also bought a lot. I mean, we saw the Solana ETF be the all-time best-selling ETF, and to see the tremendous success of IBIT and the other Bitcoin ETFs. Now, with understanding that these products were not allowed to be sold, that's truly extraordinary. Now, I think it hides the fact that you had firms like Bitwise and others putting in the work over the years. I mean, they've done tens of thousands of meetings with these brokers, try to get them to be interested in this product. But there's only so much you can do when the firm is making it unclear and even kind of insinuating that they'll get in trouble if they recommend it. So if you're a typical money manager and you've got 10 minutes a month with your client and you've got 1,000 products to choose from, are you going to choose the one that your company is kind of wishy-washy on? Probably not. So that's a huge unlock. I think the most overhyped thing is this view that the U.S. political establishment has now swung firmly and forever into the pro-crypto camp. I think that our industry is doing a really bad job of planning for the future. And I think if you do have a pendulum swing back and the Democrats were to take control in some way, whether it's midterms or more, I think we are setting ourselves up for a lot of angry, resentful, vengeful politicians. We wiped the floor with them in the last electoral round, and we somehow want to keep reminding them of that, when in reality we should be bridging gaps and picking people up off the floor versus standing over them and gloating. So that's my best thing and thing I'm most fearful of.
Excellent. Hey, I think John's heading for office down on the hill after this job, right? That's it. So, Robert, let me turn to you, because not everything was great this past year. And in fact, just recently, and not everybody in the room might even appreciate it, on October 10th, the entire crypto market had a flash crash. Was not pretty. Some of it was a flash, came right back. Some of it was not. Maybe you could speak to that, like what happened? What are the reasons behind it? Did it teach us? And also, one of the things that I noticed that my clients, because I'm representing huge institutional buyers who often run leveraged portfolios. Obviously, if you have a highly volatile asset and you lever it up, it becomes even more volatile. So the automatic deleveraging features that are out there in the crypto market, they worked, maybe too good. Maybe you could speak to that as well.
Yeah, no, absolutely. As you said, it was crypto's largest liquidation in the history of crypto. And some of the numbers that have been batting around, you got to be careful with the numbers, but 20 billion, 25 billion, I think it's probably a lot higher than that as well, because a lot of the exchanges around the world and a lot of the, particularly in DeFi, don't necessarily report the numbers that well. But it was a huge stressful event with a ton of cash, a ton of assets just gone. So why is that important? Well, as we get more and more institutional investors into this space, we have to be very cognizant of the differences between TradFi and crypto. And whereas 2022-23 was really a lesson in counterparty risk, October 10th was a lesson infrastructure and how robust our infrastructure is. And the lesson was, it wasn't a failure. I wouldn't really call it a failure because crypto still exists. And after 24, 48 hours, the markets resumed as normal. We kept trading, and markets have been actually until this morning fairly stable. But it was a test, and the result wasn't all that great. Now the day started fairly normal, and we get auto liquidations fairly regularly. We actually had a liquidation event this morning. A few hundred million gets cleaned out of the system, and that's how crypto just naturally manages its risk. And I think coming from TradFi, I was in TradFi for 25 years, I think it's actually a fairly good system that's developed in crypto. The difference on October 10th, however, was that as the market sold off and you started seeing the cascade of liquidations, the clubs on the exchanges, particularly some of the newer ones with perps on altcoins, couldn't handle the auto liquidations. And so the exchanges, the DEXs in particular, switched to auto deleveraging. Now, if you're in TradFi, I don't blame you for not actually understanding what auto deleveraging is, because auto deleveraging is built into most of the risk management protocols within TradFi, but it's never used. It's a nuclear button.
And if you did, you would deleverage my losing position, not my gaining position, typically.
Yeah, they just pair all the losers against the winners, and then everything gets wiped out. So you only do this in TradFi if your exchange is about to go under. But in crypto, it tends to be used a little more loosely, and it hasn't really been used all that often, but it was very, very prominent on the 10th. And so why is this important? Well, it's important to understand the differences. And I think at the end of the day, ADL aside, I think we learned a few important lessons. Number one, the crypto market's still very much fragmented. We've been talking about a fragmented market for many, many years. It's still very much fragmented. And even during the course of the liquidation, and now keep in mind, this liquidation was about an hour and a half in total. It was very, very fast. We saw
Less.
Yeah, we saw incredible price discrepancies, and even in BTC across exchanges and across platforms. Number two, collateral mobility was a real issue as well. So there were exchanges and platforms that froze deposits. Now, if you freeze deposits, you can't have liquidity providers move on and take advantage of arbitrage opportunities and bring all the exchanges back in line. That's a big problem. And in TradFi, we have FCMs that help take care of that. That doesn't exist in crypto. So that's something that we should, as an industry, think about how we can incorporate some of those good portions of TradFi. And then finally, there's no standard protocol for any of these exchanges. So there's no pauses or market stoppages for everyone to catch their breath. It's just pure animal instincts at that point. Each exchange has its own rules and its own protocols. And as a trader, as an investor in this space, you should be very, very cognizant of the unique attributes for each of these exchanges.
Yeah, and I would say, and in the depths of that, it was really, it was happening so fast. It was machines trading, really not so much people. And when you do that, and then the next bid gaps down, and so it just accelerates on itself. And as we all know from even TradFi, liquidity is there normally, but sometimes it's not there at the time you need it most. And this is the same thing, it probably double down here in digital assets, because liquidity is not what it is in CeFi. So Adam, let's move on to you. And so over the past year, like what have you seen, like regulatory wise? What are the things that have excited you? What are the things that you think is propelling the industry, and maybe good and bad?
Yeah, I think the title of the panel, right, 1 year on, is pretty significant to what John said earlier, right? That pendulum swing has been really, really dramatic and in very, very short order. So we've seen some pretty remarkable movement, some sentiment shift, some now much more approachable regulatory regimes where we can actually start to make some progress in the space. One of the most notable ones has been the Genius Act from a stablecoin kind of comprehensive regulatory setup. You have the ability now to have some actual structure behind what it means to be a stablecoin, how they're defined, what the reserves look like. If you spent any time at the crypto summit that John's team threw earlier this year, it was very, very focused on stablecoins. You have Standard Chartered calling it the first killer app in digital assets. So finally having some semblance of true comprehensive regulatory structure on the stablecoin side is really important. Where we're probably still missing a piece is, I think the aptly named Clarity Act, which by design should give more kind of robust infrastructure and industry-wide clarity in terms of what it means to be different market participants within the space. So there's still some work to do on that front. I think one of the most interesting pieces that maybe went a little bit under the radar was the CFTC announcement around non-cash derivatives. So there was an announcement a few weeks ago from them. You can now post, it's been approved to post stable coins and tokenized assets within the traditional U.S. derivatives market from an initial margin perspective. As a collateral manager, very, very interesting to us because you start to open up a world where you start to benefit from the best of all that blockchain and digital assets are designed to do, the ability to do things quicker, cheaper, and with less risk. So there's a huge benefit to starting to see that unlock. I think you're starting to see within that space a pretty interesting shift of the digital infrastructure starting to transform traditional market infrastructure, which is very exciting for those of us who've been in the space for a little bit.
Great. And then Sam, from an asset management perspective, given this backdrop, given the changes, what have you seen changing? What are the big investment themes? What have you seen emerging? What's making money today?
Yeah, so thank you. And great answers, by the way, up here on the panel. I'm humbled to be here. But I'm going to zoom out a little bit, right? And despite the October 10th drawdowns, despite a lot of what we're talking about poking regulators, crypto, like in the Monty Python movie, is not dead yet, right? We're still here. Somehow we're still here. So zooming out, I like to say that there's never been a better time to be investing in digital assets than there is right now. Institutional, retail adoption is soaring. The rally itself that we've seen over the past year is pretty historic, and it's been fueled by macroeconomic and regulatory tailwinds. Products like digital asset treasury vehicles are broadening access to the space. Tokenization of stocks, real world assets is happening right now. And we've never had a more friendly regulatory environment coming out of DC, notwithstanding upcoming potential changes, et cetera. We've never had a more friendly regulatory environment coming out of DC. So this is all kind of a backdrop for what I see as drivers to price price action moving forward, which is what we do. First, institutional adoption. I think it can't go without saying that institutional adoption has been a major driver of this rally. I think it continues. Bitcoin is now on the balance sheet of over 100 publicly traded companies. And what I think you see in the next year is you're going to see both the number of companies and the amount of Bitcoin that they hold increase. Stable coins cannot be underestimated how massive the Genius Act is for crypto, for stable coins, and for the banking industry going forward. There is not a major bank center bank out there right now that does not have a stable coin project or product in the works or about to launch, which are going to make payments quicker, cheaper, faster for both banks, interbank, as well as intrabank. And finally, just from a market's perspective, the interest in the space from a consumer as well as from institutions has never been greater.
Great. So let's shift focus now. So that was what happened over the past year. Let's take a brief look forward where we see things going. Adam, let me start with you. Like, where do you see things going? What role do you see like tokenized real world assets playing this year, and how things going to change for us?
Yeah, I think the tokenized real world asset space, the tokenized traditional asset space, whether it's private credit, whether it's real estate, whether it's some other kind of illiquid asset, we've seen an unbelievable progress and growth, to Sam's point, driven by that institutional adoption, which has been enabled by some reg clarity. And I think there's a component of technological maturity that's helped on that front as well to help facilitate a bit of that growth and that build out. We've seen these tokenization pieces move, I think, a little bit from proof of concept projects to really being instrumental, parts of mainstream infrastructure, which has been kind of a fun thing to see over the past couple of years. You saw 300% growth over the past 3 years. I think it's a $1.25 trillion industry, expected to become 30 trillion in less than a decade. So in very short order, we expect some pretty significant hockey stick growth within that space, which I think is super exciting. You have Larry Fink at an earnings call saying, we're at the beginning of the tokenization of everything. That's a pretty telling statement from a pretty influential market participant. And I think to Sam's point, you have the BlackRocks, the JP Morgans, the Goldmans, the Bonnies, the Franklin Templetons that are all active in the space, creating products, actively launching tokenized funds and instruments. So I think it's certainly an exciting piece to continue to see grow. I don't think I think we're at the early stage of it, but it's definitely reached critical mass, and I think it'll continue to grow from here.
Thanks. One of the other things that's happened over the past year is the emergence of these digital asset treasury companies. So this is like a MicroStrategy type company. It's publicly traded. Its only business model is to own a single token. A couple times maybe it might be more than one token, but most of them are a single token play. And to me, that's just an access play, but they're proliferating. There's a bunch of registration, bunch coming to the market. So Sam, what is your take on those digital asset treasury companies, and where's it going?
Yeah, so I don't think that you can underestimate how important digital asset treasury vehicles are to accessing crypto. So let me start with a statistic. Liberation Day, April 1st, Donald Trump declares tariffs, essentially trade war with the rest of the world. U.S. equity markets in the next 5 days have a temper tantrum and lose $5 trillion in value, which is, okay, that's big. The entire world of crypto at the time was worth only $2.5 trillion. So I'm giving you kind of a sizing of opportunity here. Fast forward, digital asset treasury vehicles pioneered by MicroStrategy. Michael Saylor was out front in terms of acquiring Bitcoin on your balance sheet and doing some financial engineering via what's called MNAV, or a multiple of NAV. This worked for a very long time, but what we're seeing right now in the digital asset treasury world is, as I like to say, DAT 1.0 is moving on and evolving into DAT 2.0. DAT 1.0 was about a lot of these companies coming out, being very hastily put together, not understanding that this is a TradFi product that broadens access to the asset class for people who don't want the complexity of crypto rails. Think about the dentist in Oklahoma. Think about, on the institutional side, a college endowment that doesn't want to change their investment charter. Now, all that they need to do is have a prime brokerage account or a Schwab account, and they can access the asset class, right? So from that standpoint, that's a great innovation and is broadening access. From a financial engineering standpoint, a lot of these were sold as an arbitrage play to access a multiple of the NAV, or net asset value, of the crypto that the particular company holds. I think, and I said this several months ago at the Out East Summit, and I was almost laughed out of there when I said, I think MNAVs greater than 1 are unsustainable and certainly not greater than 2. And the industry was really focused on this MNAV thing. I think going forward, what's happening is the market's maturing. You see fully 50% of the treasury companies on Blockworks that are being tracked right now in terms of MNAV, fully 50% of these are trading below 1, which that sounds like an arbitrage to me. and only 2 trade above 2 MNAV. So I think DAT 2.0 is more about understanding this is a TradFi product. You're going to see higher quality deals coming out with TradFi or traditional finance executives and boards with a focus on increasing the number of tokens per share rather than a multiple of NAV. And how do you do that? Well, you start by saying, I'm not going to go out and spend all this money that I just raised in one weekend and let the market essentially take the opposite side of that, which is exactly what happened for the past several months. And trust me, this was a really good trade to take the opposite side of in the crypto market. But from a DAT 2.0 perspective, you want to buy your tokens opportunistically. You want to buy your shares back and have dry powder to be able to defend that. Tom Lee at BitMiner has written the playbook. I think it's going to continue.
Great, thanks. And John, from your perspective, looking forward the next 12 months, whether it's regulatory, legislative, or just business-wise, what do you see happening?
So I see that, first of all, I agree with Sam, and I'll note that.
Thank you.
Just this one time, don't get used to it. I'll note that we have a precedent for digital asset treasury firms in TradFi. It's Berkshire Hathaway. Berkshire Hathaway is a stock asset treasury firm. It's a guy who for 40 years or so has been buying 7 to 9 publicly listed stocks that any of us can buy. And by the way, there's not just Berkshire. There's a litany of Berkshire lookalikes that have all traded above par value of their underlying. And we trust them. So I view DATs as, quite frankly, liquid hedge fund vehicles. And the better ones will survive, and the bad ones will go away. And I think Sam's right. So I don't know if they trade below 1 forever, but certainly below 2 and somewhere in between. For me, I go back to my original point. I think the most exciting thing next year is to see, and it may take longer than a year, is this army of brokers really excited about selling this asset class. That's what we've never had. We've never had, like, who are the killers? I've asked every crypto firm that's come to me with an idea. I'm like, this all sounds wonderful. Who are the killers who are going to be working the phones, working the rooms, working the golf courses? Because again, I think for the foreseeable future, these will be sold, not bought products. And you got to have your killers. You got to have your army. And we haven't had that army. Now, what we had is amazing marketing. In the sense that everyone's heard of Bitcoin. My mother's heard of Bitcoin, right? That's wonderful. So when products, you don't have to spend, at NYMEX, we used to develop these wonderfully beautiful instruments. They like perfectly solved a value transfer, risk transfer problem the OTC market was happening, right? Remember, what was his name, the head of research? Smart guy.
Bob Levin.
Bob Levin. And we sit in a room, we say, okay, the OTC guys are trading this. Let's make it a fungible instrument, work all the math out. Oh, there's a thing of beauty. Let's list it on Clearport. Wah, wah, wah. Like, it just wouldn't trade. And we didn't know why, because there was market. I remember, I'll tell you a quick story. I remember when the jet fuel contract launched, and people weren't buying it. And I remember going into marketing, and they were on the phone with like the airlines. They were like, hey, you should use this thing to hedge your, and the airlines were like, the CFOs were like, no, we don't do that. We don't hedge. We don't speculate. And we had to talk to the analyst, the equity analyst, to say the next time some idiot says he missed earnings because of rising jet fuel prices, say, why are you speculating? You are short jet fuel. Use the derivative to not speculate. Until you hedge, you're speculating. But it took a while for that mental switch. So you need the killers, you need the salespeople. So that's what I'm most excited about.
I love it, yes. He who controls the narrative controls the market. That's excellent. So, Robert, turning to you, obviously the derivatives market in the crypto space is nowhere near what it is in the traditional finance space. So why don't you let us know what you're seeing there, where you see that going this year, what you'd like to see this year, and what would help the market?
Yeah, I mean, it's a fraction of its potential at the moment. It's actually, if you look at the equity markets, for example, the derivatives market is multiples of the underlying spot. It's the exact opposite in crypto. So there's huge amount of upside in the derivative space. And as we see more institutional investors coming into this space, more institutional adoption, we're seeing the sophistication level rise exponentially. And that's actually what's leading to compression in realized vol in BTC, much more stable price action, and this like conversion into kind of an old, boring market, which actually in some respects kind of led to what I was talking about earlier on the 10th. Now, from a derivatives point of view, we've been the market's been trading options for quite some time. Deribit's a huge market that's like 90+% of the marketplace. There's a lot of other exchanges that are coming in place. We trade at OTC, and we've been seeing great expansion of interest there. The ETFs now also have options markets, which are very liquid and traded. But we're also seeing new entrants coming in. So DATs, for example, are coming into the derivative space. So Sam, to your point, DAT 2.0, it's no longer effective anymore to just hodl these coins. They need to create yield. They want to create some buzz around it. They need to outperform the other DATs in their peer group. And so we're speaking to DATs about yield enhancement strategies, forward strategies. If they don't have that cash on hand, they're buying forwards in anticipation of the cash coming in. So they're getting much more savvy around that area. We're also seeing more RIAs, so all the dealers are coming in. It really looks like it's starting from the wealth management sector, because these are the clients of the banks that are really demanding exposure. So now we're starting to get a lot more interest in exotics and structured notes. Again, as BTC vol plummets into the 20s and 30s, which is like a TradFi level of implied vol, it naturally begets more interest in exotics and structured products. So we're definitely seeing much more of a two-way activity, a lot more sophisticated investors coming in, and a lot more fun stuff that's going through the options market now.
Awesome. So a lot of great stuff coming this year. So let's close this out real quick each, 30, 40 seconds. What is the single thing you're looking for out of the digital assets market this year that you think is really going to propel the industry, bring it to the next level, open adoption, whatever it is that you think is the big thing this year? What are you looking for? Let's go down the line, Robert.
I mean, I was in TradFi for 25 years on the rate side, which is probably the most archaic part of an investment bank in terms of like settlements and infrastructure and operations. So for me, the most exciting area is really blockchain innovation, bringing in, permissioned public blockchains. We're seeing developments in repo trading, in real-world asset trading, tokenization. The framework is now being built and used, by the way, by banks and asset managers to really bring TradFi into the next century, and seeing that develop is super exciting for me.
Okay, so blockchain development, Adam?
Unimaginative answer. On the regulatory side of things, we need a functioning federal government in order to move things forward. On the Clarity Act side of things, I think more broadly speaking, what I think is very interesting is we've got this world where you've got the traditional financial markets and you've got the crypto markets. It's the melding of those two that I think will be really fun to watch, kind of to Robert's point, over the next year, to see how that kind of comes together. I'm of the opinion that we'll get to a spot where it's just the markets and there'll be no distinguishing between the two of them. Digital assets will be just an asset class within the broader market structure. And I think you'll start to see a lot more of kind of the blockchain technology and the distributed ledger technology step into the traditional market infrastructure, as we kind of talked about on the derivative side of things. I was doing some research recently on settlements, which is indicative of how exciting my life is. But the settlement movement in the early 90s from T+5 to T+3 was facilitated effectively by two catalysts. Those two catalysts were the prevalence and growth of DTCC from a central counterparty clearing perspective, and the other was a technological advancement. I'll challenge the room and the panelists. Do you know what that technological advancement early 90s was that was the driver for a reduction in settlement cycle from T+5 to T+3? Internet's a good guess. I would have guessed email. No. The fax machine. The fax machine. DTCC and the fax machine in the early 90s were the catalyst for the move from T+5 to T+3. We've obviously come a ways from then. But I think it's interesting to see where that was 30 years ago. The development we've seen technologically over the past 30 years is incredible. And I think starting to see faster, cheaper, and less risk, all the things we kind of anchored on today, That's the vision of DLT. That's the vision of blockchain technology. And I think that inserting itself in the traditional financial markets is what's going to be fun to see over the next year.
And quickly, Sam.
So really quickly, as somebody who has built exchanges, built match engines, I've got a couple of patents for that too, little self-promotion. But as somebody who's done all of this, I don't think it can be underestimated what impact a DEX or a distributed exchange like Hyperliquid will have and is having on the exchange space. So I'm really looking forward to that. I'm really also looking forward to Coinbase's takeover, which is complete now, of Deribit, and how they'll improve that market and access. And finally, alongside of everything's been said, the maturation of technology in the space to enable faster, quicker trading is what I'm looking for.
Awesome. And John, pay no attention to the clock.
Clarity Act.
We started 2 minutes late. You have
3
2
words.
minutes.
5 words. Clarity Act, stablecoin interest rates, stablecoin yield, and maturity of messaging.
Wow, I love the conciseness. Awesome. We're out of time. Thank you, everybody. We'll be in the room if you want to ask questions. Thanks.